Welcome back to the Longacres Finance channel. The dividend stock I want to talk about today is down 30% year to date and nearly 40% from its 52-week high. It sports an attractive dividend yield not seen since the 2020 pandemic lows. But does a declining share price and historically attractive dividend yield determine whether or not a stock is a good investment? Absolutely not. For me, two things determine if a specific stock is a good investment. First, is the company a great business? And second, does the valuation make sense? Plain and simple, if a company isn't a great business, I don't care how cheap the share price looks. And the same goes for great companies that are grossly overvalued. The dividend stock I want to highlight today is Rowe Price Group, ticker symbol TROW. So join me to find out if Rowe is a great business and if the current valuation makes sense. First, I'll give you a little background on the business. Then we will dive into the past results and take a look at future prospects. I'll wrap things up with a dividend review, valuation breakdown, and I'll show you my current exposure to the stock. Let's jump right in. Rowe Price Group is a publicly owned investment manager that was founded in 1937. They provide a range of services to individuals, institutional investors, and retirement plans. Rowe manages $1.55 trillion that it has under its management. Their primary source of revenue are the fees they charge on the assets they oversee. And recent results have been quite exceptional. 2021 net revenues climbed 23.6% year over year. Net operating income also rose 35.1%. Assets under management at year-end were $1.69 trillion, which is higher than the current AUM figure. Market volatility is the main driver for the decline in AUM during Q1 of 2022. This should also lead to lower revenues and earnings for Q1 that will come out on April 28th. In December, Rowe finalized its acquisition of Oak Hill Advisors. That sees $57 billion of alternative credit assets come under its umbrella. Rowe plans to leverage Oak Hill's expertise to expand its reach into private market alternative strategies. The one negative factor in 2021 were net client outflows of $28.5 billion. This continues to be a trend in the industry as investors move from active to passive investment options. For Rowe, net client outflows are primarily concentrated in the equity space. As per the CEO, fixed income saw net client inflows in 2021. Management expects flows to improve in the future, with a long-term target of 1-3% growth, driven by strategic initiatives, expanded capabilities, and deeper client partnerships. If we move out further back in time, Rowe has seen revenue growth for 10 consecutive years now, averaging about 11% year-over-year increases. Operating income has grown at about 12.5% per year, and operating margins have gradually improved and remain at a very strong level above 40%. Rowe has been actively buying back its own shares, with an average reduction of 1.2% per year to total outstanding shares since 2012. The company has also seen earnings per share grow year-over-year during the last decade, averaging almost 14% annual growth. Dividend distributions line up with earnings per share growth, also at nearly 14% per year. This link in dividend and earnings growth allowed Rowe to maintain a healthy payout ratio below 40%. These are very healthy and strong financial results over a long period of time, and it reflects positively that Rowe is a great business with a competent management team. Some near-term risks for the firm are client outflows and the economic outlook. Seeing a negative outflow of client assets is never a good sign for an investment firm. Rowe has to strive to maintain and grow its client base to drive future growth. I think management is doing a fine job and taking the necessary steps to strengthen client relationships and offer alternative products to drive future inflows. Much of Rowe's revenue is tied to its assets under management. In a volatile market, assets can decline rather quickly, and it looks like Rowe's AUM has declined by approximately $14 billion in Q1. This will certainly have an impact on Q1 revenues. There's little Rowe can do about market volatility. I think their focus is better spent on delivering strong returns and expanding their customer base. Analysts are forecasting 2022 revenues to decline by 1.4% from 2021. However, 2023 and 2024 are forecasted to see positive growth. Bottom line earnings per share follow a similar trend, with a small decline this year followed by continued long-term growth. Let's switch focus now to Rowe's dividend history. The company has a 35-year streak of dividend growth that is absolutely amazing. Not only have they grown their dividend for 3.5 decades, they are also maintaining a fast dividend growth rate. The most recent dividend increase came in at 11% in February of this year. Over the past 5 years, they have averaged about 15% growth and a very solid 14% growth rate during the last 20 years. Today, the stock sports a dividend yield around 3.5% that looks very attractive compared to the 5-year average dividend yield of 2.6%. It's not quite as high as the 4% yield the stock offered during the 2020 pandemic lows, but still at a very good level. The forward PE ratio of 11.9 also currently sits below the 5-year average of 15.1. These two factors suggest the price of the stock may be undervalued right now. With that, let's dig into the valuation for Rowe. I'll tackle this from a few different angles and average the results out at the end. In terms of dividend yield, we can use dividend yield theory to come up with a fair value for the stock today. The current forward dividend rate is $4.80 per share. Based on a share price of $135, this gives us a 3.56% dividend yield. If we compute a fair price for the stock using the 2.6% 5-year average dividend yield, we come up with $184.62. At this price, the current dividend rate would result in the stock having a 2.6% dividend yield. This points to a potential 27% undervaluation right now. Comparing the current PE ratio of 11.9 to the trailing PE ratio of 15.1, we can see a potential 21% undervaluation. If we average both of these amounts, we come up with about a 24% undervaluation. For me, this is significantly low enough to suggest shares are attractively valued and offer a good level of margin of safety. But to take this one step further, let's try to compute a potential long-term rate of return for the stock. To do this, I forecasted the income statement for T. Rowe 5 years into the future, through 2026. To forecast an income statement, I have to make some assumptions about long-term growth, and I typically like to use conservative figures. Let me walk you through these assumptions, and then I'll show you the forecasted rates of return. If you recall, revenue growth during the last decade was 11.1% per year. My forecast for the next 5 years assumes revenue will continue to grow at 60% of this level. 11.1% times 60% is 6.66% per year. This would see revenue grow from $7.7 billion in 2021 to $10.6 billion in 2026. My operating income growth assumption is the same at 60% of the trailing 10-year average. Since operating income grew faster than revenues during the last decade, this would result in an improved operating margin that would push slightly past 50%. For net income, I used the same assumption. As a result, net income would climb from $3 billion to $4.8 billion. The number of outstanding shares has declined by 1.2% per year on average, and I forecasted the same decline to continue for the next 5 years. This would result in a reduction of about 10 million shares by 2026. My forecasted earnings per share are just a computation of net income divided by the number of outstanding shares. And for dividend growth, I assumed a growth rate of 80% of the trailing 13.9% average growth for the last decade. The reason I used an 80% assumption is that I wanted to keep the payout ratio pretty much in line with where it sits today, around 33%. The first piece of information from this forecast I will use is the dividend rate in the year 2026, which is $7.31. If we take this dividend rate and divide it by the 5-year average dividend yield of 2.6%, we come up with a fair price of about $281. The current share price is $135. If we hold the stock from today till the end of 2026, we will also receive 5 years worth of dividend payments. Using my forecasted income statement, I estimate that amount to be $29.95 per share. We can use the forecasted fair price in 2026 of $281 and the projected dividend income of $29.95 to compute a potential rate of return based on today's price. That rate of return is about 18% per year, which to me is a very good rate of return. You can also notice that if we buy a share of T. Rowe stock today, and it'll pay us about $30 in dividends over the next 5 years, we will get 22% of our investment back in the form of passive income. Reinvesting those dividends would likely improve this rate of return. The other method to compute the potential rate of return for T. Rowe can be extrapolated from the future earnings per share figure. In 2026, the EPS forecast is $22.12. And if we multiply it by the 5-year average PE ratio of 15.1, we come up with a fair price for T. Rowe of about $334 in 2026. If the share price were to climb to that level, we would have a resulting annual rate of return of about 19% from today's price of the stock. Both of these rates of return look very appealing to me. And even if my conservative assumptions prove to be too optimistic, I would be fine with a lower rate of return from this stock. My personal target is a 12% annual rate of return, so there is some margin of safety here. There's no guarantee that T. Rowe will continue to grow in the future, or that the valuation will recover either. But I believe this is a great company to own, and the valuation today makes sense. I believe the stock will do great in the long term, but may continue to be volatile in the short term. It looks very attractive to me at today's price, and if it falls further, it'll become more of a bargain. The past few months can show you just how crazy the stock market can be. How can a company that is fundamentally the same today as it was 6 months ago trade for prices that are 40% different? If investors were willing to pay $224 for the stock 6 months ago, they should be buying hand over fist for $135 today. T. Rowe is the 8th largest holding in my portfolio right now, and I have been adding more money to this position recently. I will likely continue to add more in the future as the price and dividend yield continue to look attractive. I have about a 16% loss on my position, and my yield on cost sits just below 3%. But I expect the stock to reward me with a strong long-term return, and offer ample passive cash flow in the meantime. That's it for today. If you enjoyed the video, please give it a like and subscribe to the channel. Thank you for watching and see you next time.